As the saying goes, never let a good crisis go to waste. I've already added a few stocks to my personal portfolio, and I'm continuing to look for even more value opportunities. During my research, the used car market has caught my eye. Although I'm not looking to invest in the auto industry. Instead, I'm looking at car prices. There's a good chance the used car market will crash in 2020, and already we're seeing some early warning signs, which I'm about to cover. Last year, I shared my research on the growing auto loan bubble. Total loans have climbed from about $700 billion in 2010 to almost $1.2 trillion today. Now, with this recent self-induced recession, the car loan bubble is set to deflate. So if you're in the market to buy a car, it might be good to wait. You'll likely find better deals as more auto loans default. On top of that, car buying demand is decreasing in other areas, which I'll also cover today. This will push prices down even further. Now, before we dive in, I'd really appreciate it if you just tap the like button down below ever so gently, as well as subscribe to my channel. With many Americans forced to stay home, less rubber is hitting the roads. In my neck of the woods, the Baltimore and DC area, rush hour traffic virtually no longer exists. Of course, traffic will come back, but jobs on the other hand, not so fast. And as income has disappeared with jobs, less people will be able to afford their car payments. Since the Great Recession in 2009, the US has added just over 22 million jobs to non-farm payrolls. It took over 10 years to add that many new jobs. But in less than 2 months, total unemployment claims have spiked to above 33 million, and more will follow. The government has stepped in with direct economic impact payments. I got mine along with a letter from the White House. Although this isn't enough for most Americans with lost income, the bulk of recent government bailouts have gone towards businesses to prevent job losses and also ease credit markets. To prevent a sharp downturn, the Fed is manipulating markets in an unprecedented way, and modern monetary theory has some dangerous flaws. Although that's a topic for another time, I don't want to go down a rabbit hole. The chart I have for you today shows the drop in the 10-year interest rates. It's been a bit volatile, but it's decreased. And the blue line shows the growth in total auto loans, which I had mentioned. Lower rates make car loans more affordable, although the government can't push rates much lower. Going below zero is possible, but it's not sustainable for the world's reserve currency, the US dollar. And anyways, based on the number of jobs and income lost, it won't be enough. On top of that, as I mentioned, there are some other trends putting downward pressure on car sales and dealerships. The growing gig economy is reducing the need to own a car, especially for people living in cities. Cities continue to attract more people as well. With the rise of technology, ride-sharing apps like Uber and Zipcar make getting around without owning a car more convenient. It's also becoming more cost-effective. It'd be nice not to have to pay insurance, car registration, taxes that go along with that, gas, emissions checks that might be unique, or emission check fees that might be unique to Maryland, heavy repairs and maintenance, parking costs, the occasional parking tickets, and the cost of car ownership goes on. Looking forward, automation will also push down the demand for car ownership. A while back, I researched driving automation and put together a list of 25 driverless car pros and cons. Lots of people overlook the impact driverless cars will have. I'll link to that research down below. The future is interesting to think about, but that's still a ways out. So let's go ahead and dive back into what's happening in the car market in 2020. According to the Manheim Index, wholesale used car prices have dropped more than 11% in April. That decline is month over month, and when looking year over year, they're down 9.2%. When there's a big drop in wholesale prices, retail prices often follow. So we'll likely see used car prices crash in the months ahead. After the 2008-2009 crisis, we didn't see the total amount of car loans bottom out until well into 2010, as you saw in the chart. The recent spike in unemployment will lead to more subprime auto loan defaults over the next year. Used car repossessions will also put downward pressure on the car market. Overall, it's not looking good. Auto dealerships are also struggling. Many of them operate on leverage. Cars on their lots are often financed through bank loans, and the dealerships need to turn over their inventory to meet their payments. So with decreased buying demand from the recent economic shutdown, they're being forced to lower their prices to sell cars faster. It's a tough situation, but it isn't all bad. With any crisis comes opportunity for those who have prepared. We know that history repeats itself. And in the used car market, there will be better buying opportunities ahead. This isn't the first car market collapse, and it definitely won't be the last. On another positive note, the collapse in oil prices is helping us all out at the pump. There are plenty of silver linings if you just simply look for them. The decrease in fuel prices has also created another great buying opportunity. I recently purchased shares of ExxonMobil, and I'll go ahead and link to that as well. Now that wraps up my research for today, and I'd really appreciate it if you just tap the like button down below, as well as subscribe to my channel. Please let me know if you have any questions.